So yesterday, in the last week, it has been just a wild ride in the markets. Yesterday, down 1,000 points at the open, a lot more if you owned an ETF, a bounce back, but still a loss of close to 600 points. And then this today, we like it. But it does beg the question, the kind of volatility we're seeing, the wild swings. What about 2008? Is this 2008 all over again? Former Tim Geithner aide during the financial crisis back then, Aaron Klein is here. He says doesn't panic. It isn't the same. Why not? I guess when we were talking before the show about this, I thought this is an option, that this is 2008 all over again, that the entire banking system around the globe is going to collapse. That's not possible.
No, it's not. Thank you for having me here. I was there in 2008. I remember when the stock market fell 1,000 points in an hour when Congress unexpectedly voted down TARP. That was a financial panic. This isn't a panic. There's a lot of volatility. There's huge swings in the market, but this isn't the beginning of a house of cards collapsing that threatens our financial system.
But we were my guest in the last block was talking about the leverage within the energy sector, within a lot of these energy companies. I do worry about the financial exposure of banks and other lenders to that. Is that worrisome to you, if you want to talk about kind of shaky financial underpinnings?
Sure. There are a lot of areas to be worried about. Energy is one. Usually when there are huge booms and busts in the energy cycle, banks, particularly regional banks in the oil patch and now in some of the fracking areas in North Dakota, they could definitely suffer. Banks with exposure to companies that do a lot of business in China and Asia could potentially suffer. But there's nothing endemic going through the system here. This isn't a moment to worry about our financial stability. But it is a moment to worry about energy. And the price of oil may continue to fall. It's not clear that that's a bottom.
What does this look like to you, Aaron? Like what time period?
It reminds me of some of the market volatility swings that we had during the accounting scandals of 2002. People forget that during the Enron scandals, the market fell almost half in value on the equity side. And it also reminds me a bit of the taper tantrum in 2013 when the Fed was getting close to liftoff and raising rates. It spooked the markets freaked out, and the Fed backed off. I think that's going to happen again.
Do you think that some of this sell-off, because we talk about China, you have the commodity bubble bursting. Do you think some of the sell-off, if not a large part of it, is directly related to people worried about the Federal Reserve raising rates just 1/4 of a point next month?
Absolutely, because it's not just the 1/4 of a point, it's a signal that 0% interest rate is over. And not how much are rates going to raise, how fast are they going to raise? The Fed keeps saying they're going to be raised gradually, but what does that mean? Investors are not certain. You know, historically, when the Federal Reserve starts raising interest rates, recessions happen a couple years later. The Fed's determined not to have that happen here, but that would really be bucking history.
But when are we going to get off the sauce? You have people out there actually talking about wanting the Fed to come back in, not only not raise interest rates, but start buying bonds again. When is this going to end? At least TARP and that bailout, that's kind of over. That's in the past. But this bailout of everybody, and particularly speculators, has been going on since then.
Well, look, speculators ought to lose. If you made an investment and it didn't work out for you, you ought to lose. As you point out, TARP is mostly over, and I think history will look back on it pretty kindly. It stabilized the financial system, turned a profit for U.S. taxpayers with regard to the investment in banks. The Fed's era of 0% interest rate, they're in a quandary because they need to raise rates, as you point out, to get us off the sauce. On the other hand, the mere act of raising rates tends to trigger the very recession that they're trying to avoid. They're trying to put bullets back in their gun to be able to fire the next time there's an economic slowdown. And in the process of reloading, they may cause a very problem they're trying to solve.
Well, and the thing that's quite frankly irritating is we haven't even seen, they haven't raised rates yet. They've indicated that they might sometime between now and the end of the year. And you haven't even seen economic weakness because of that. You're talking about a slowdown or a recession. We've just seen market gyrations and people start losing their minds.
You have seen market gyrations because they're not sure. Look, the Fed's had 0% interest rates for a long time. Liftoff is going to be very tricky for the Fed. But you've also seen commodity price collapse, as you point out, and there's no inflation. So people are asking, why are you raising interest rates if there's no inflation?
Right. Well, the Fed also doesn't like bubbles, and that one just burst. So that's one less one they have to take care of, I suppose. Aaron, it was great to talk to you. Thank you so much for being here. Aaron Klein.
Pleasure is mine.